real interest rates are still negative, and that's like nitroglycerin for gold. And the reason why gold hasn't been going up is because the price management squad, the Western central banks, have been so far successful at keeping a lid on the price of gold, but they haven't been able to drive it lower, right? For 3 years, they really haven't been able to drive it lower because we're at the same level where we were 3 years ago. And so that tells you that I think what the influence is that's keeping it, from keeping them from being able to push it down further with derivatives is all the physical demand coming from the Eastern Hemisphere. And again, that's something that gets overlooked by everyone except, the gold bug community.
Gold held steady on Friday, set for its second consecutive weekly gain, supported by a weaker U.S. dollar as markets grew confident that the Federal Reserve was done with its interest rate hikes. DaveKranzler, founder of investment research Dynamics, predicts that negative real interest rates and physical demand from the Eastern Hemisphere will drive higher gold prices. Ongoing geopolitical tensions underpin longer-run bullish fundamentals, including the rising demand from central banks for physical gold amid growing pressures on the U.S. dollar's reserve currency status. Dave notes the precious metal sector is struggling, despite the Middle East-driven boost. The direction of gold prices quickly changed following the outbreak of the Israel-Hamas conflict on the 7th of October, with the precious metal nearing its record of about $2,075 set in 2020. Gold rallied 7.3% last month, as demand for safe haven assets has increased. Dave notes Eastern central banks, including unexpected players like Poland, actively accumulate gold. He suggests OPEC countries, including Dubai, drive physical gold demand, positioning the city as the largest gold hub after Shanghai. The National Bank of Poland is also very active in acquiring gold, with gold's share in its reserves exceeding 10%. In the second quarter, Poland bought more gold than China, and in the third quarter, it was second in terms of purchases. He foresees a potential market upturn as banks cut silver shorts, hinting at a bottom from the recent sell-off, significantly impacting mining stocks. Now, we present the clips of DaveKranzler's insights from his recent interview with Soar Financially. Before we continue to delve into this discussion, please subscribe to our channel and activate the bell icon for timely updates.
At some point, the geopolitical element, it dissipates, right? It dies down. Ukraine doesn't affect the markets at all anymore. So, and obviously what's going on in the Middle East gave gold a goose, but it's also, what's interesting to me, I actually wrote about this, my newsletter, is that it feels like the precious metal sector is struggling, right? It feels like it's, prices keep going down. They're not going up. If you look at gold, just look at I've got a 3-year daily chart up. It got as low as 1620 back in, September 2022, but then it bounced right back up 2080. And so it's kind of been in a 3-year lateral trading channel, right? And, the price management team doesn't want it to go above 2100, and they've been able to maintain that successfully since August of 2020. But it hasn't, if you just cut out the two sharpest spike downs in that 3-year period, really it's been holding at 1800. Silver probably looks somewhat similar, but we'll just keep it with gold, just to keep it simple. It's the mining stocks that are giving people agitation, including me. If you use a real inflation gauge, real interest rates are still negative. That's like nitroglycerin for gold. And the reason why gold hasn't been going up is because the price management squad, the Western central banks have been so far successful at keeping a lid on the price of gold, but they haven't been able to drive it lower, right? For 3 years, they really haven't been able to drive it lower because we're at the same level where we were 3 years ago. And so that tells you that I think what the influence is that's keeping it, from keeping them from being able to push it down further with derivatives is all the physical demand coming from the Eastern Hemisphere. And again, that's something that gets overlooked by everyone except, the gold bug community and the people who write about it and track the data, central banks collectively. And when you see that reported in the mainstream media, they just refer to central banks. Well, the Western central banks aren't accumulating physical gold. It's the Eastern Hemisphere banks. It's China. Russia started buying again about a year ago. India, India imported a massive amount of gold last month, and they also imported a massive amount of silver. And all of the smaller Eastern Hemisphere bloc countries, their central banks have been accumulating gold. Even Poland, which kind of surprised me because Poland is kind of a lapdog for NATO and the U.S. And their central bank started buying gold again. And not only are they buying it, they're having it repatriated from London to Poland. Because if you really understand how London works, you wouldn't trust the vaults in London, you wouldn't trust the vaults in New York. So the OPEC countries are accumulating gold. Dubai is now I think it's the second largest gold hub in the world after the Shanghai Gold Exchange. It's really, I think, the physical demand is pushing the price from below the big web of derivatives that's sitting on top of the physical market trying to hold it down. Does that make sense? Silver, that the banks got more short, but I think it was gold where they were covering, or it might have been, I forget, one or the other. But in general, the pattern over the last 8 to 12 weeks has been that the banks have reduced their short exposure to COMEX, to being net short COMEX gold and silver futures. So, I mean, you're looking for some indicators that, we may be bottomed from, this painful sell-off that we've had that's mostly affected the mining stocks, not so much the metals. And we could be heading higher.
DaveKranzler favors junior project companies, anticipating market outperformance, while featuring Fortuna Silver and seeing potential in undervalued picks like Caliber Gold. Fortuna Silver Mines Inc. AS's profitability rank stands at a strong 7 or 10, indicating a robust position within its industry. The company's operating margin is an impressive 13.37%, higher than the 75.29% of its industry peers. While observing a potential trend change, he awaits a sustained upturn, particularly in GDX, to reach further upward movement. Among industries, gold miners, as tracked by the VanEck Gold Miners ETF, sharply outperformed, rallying over 3.4%. GDX, the VanEck Gold Miners ETF, is the dominant benchmark in the sector, boasting $11.9 billion in net assets, over 31 times larger than the next largest 1x-long major gold miners ETF. It is widely recognized as the preferred trading vehicle for the world's largest gold miners. Let's get back to the interview.
Well, my primary focus in my newsletter is the junior project development companies, the micro caps, because when and if we get the move that I think is coming, that a lot of us think is coming, those are the stocks that'll outperform the most. But I also feature several mid-cap producers. I don't really care about Newmont and Barrick. I don't think they're well-run companies. And if you want a safer, a less risky mining stock, I think the mid caps like a Fortuna Silver or Hecla. There's one that I picked up coverage of about 9 months ago, I guess. Caliber Gold. If you're familiar with that one,
they just made a massive
Mining
acquisition.
Really the official name, and that one is ridiculously undervalued. And they just made a great acquisition in Newfoundland, Marathon Gold. And the market, I don't think really. I think part of what the market is freaked out about with Caliber is that they the bulk of their revenues comes from Nicaragua, but it's misunderstanding the nature of the political risk there. Yeah, there's political risk. There's political risk in every jurisdiction. Nevada has political risk, right? If you talk to mining company CEOs, in a lot of U.S. jurisdictions, it's a nightmare trying to get permits, the environmental permits, and it takes a long time. Not so much Nevada per se, but some of the other states where there's mining. California, I won't touch California. Any company that's operating in California, I won't even look at it. Yeah, I'm seeing the same thing you are with the charts. I started noticing it, I don't know, probably 4 to 6 weeks ago. And if you just pull up a handful of the micro cap juniors, like a Cabral Gold, a Silver Viper, or a Viva Gold, something like that, and you look at a 1 year daily, you can see the micro cap juniors just got obliterated relative to the mid caps and the large caps, relative to GDX, just obliterated up until maybe the fall of 2022, or maybe early this year. And then you see they kind of stopped going down, and they've been kind of going, they've been forming a long base in their charts. And to me, I don't know how much more downside. If you pick a good company that has a valid project, and it's trading at 8 cents, how much downside does it have from there? Probably not a lot. It's not going to go to zero. Because even if it becomes distressed, some company, will make a strategic acquisition just to get the resource that's in the ground. I started accumulating these junior microcaps, a few months ago. Some of them even longer than that, just because it's like, okay, the downside's limited, and the upside is 5x or 10x. But now, in terms of whether we have a trend change, I want to see a little more of a sustained upturn. Like if I'm looking at a chart of GDX, and you can see that it looks like it's trying to bottom here. And even though, again, I'm just looking, it's been in a 3-year downtrend, and you can even see it on the 1-year chart. It's been in a down, from the last rally we had. It's been in a downtrend since the end of April, early May this year. But it looks like it's trying to come out of that. It looks like it may have bottomed. And I'd just like to see it. I mean, really what I'd like to see it is get into the high 30s and hold and move higher from there.
As seen after the invasion of Ukraine, worsening political risk bolsters the demand for physical gold. Economists think the current situation is worse than Ukraine because it adds to existing tensions instead of replacing them. Gold has confounded expectations by holding near all-time highs despite surging real interest rates and a strengthening U.S. dollar in 2023. Aggressive central bank buying is providing crucial support for prices. Considering the evolving market trends, how do you envision the future of gold investments? Share your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the next video.